1. Reversing U.S. immigration, economic impacts and market reactions. 2. Economic warning. Over 500,000 could leave the U.S. this year. 1. Reversing U.S. immigration, economic impacts and market reactions. While markets have spent months transfixed by the ever-changing saga of U.S. tariffs, a new economic storyline is quietly stealing the spotlight, one with the potential to reshape the American workforce, upend growth forecasts, and redefine daily life for millions. But here's where it gets controversial. For all the headlines tariffs generate, it's actually the dramatic slowdown and partial reversal of U.S. immigration that could deliver the biggest economic shock in 2025. Let's clear the air. Financial analysts have had their hands full tracking each surprise tariff announcement from the Trump administration. It's no wonder, really, tariffs can shift the inflation narrative and keep the Federal Reserve guessing on interest rates. But lately, the buzz around tariffs has started to fade. Why? Because the real-world effects of these policies are proving slippery to pin down, and markets never love uncertainty. Take this week's deep dive into June's inflation numbers. Yes, certain product categories saw price bumps in response to tariffs, backing up the argument that tariffs are inflationary. But here's where it gets tricky. The big-picture inflation rate still came in pretty much as expected, thanks in large part to falling energy prices and other factors. This leaves the Fed in a tight spot. Inflation is still above its 2% target, and nobody's quite sure if price increases will keep climbing or just fizzle out. The bottom line? The outlook is murky, and it could take months to sort out. But now, consider the other signature move from the Trump playbook. A sweeping clampdown on undocumented immigration and a sharp uptick in deportations. Unlike the fog surrounding tariffs, the consequences of this shift are becoming much clearer, and they're not just about fairness or border policy. They're about dollars and cents, supply and demand, jobs and wages. Economists had already predicted a slowdown in new arrivals, since immigration was already trending down before the election. But the scale of the administration's deportation push, combined with a recent spending bill to supercharge enforcement, has blindsided many. The change is so rapid that it's shifting the conversation from a halt in immigration to an outright reversal. Take this headline-grabbing move from earlier this month. The U.S. Department of Homeland Security announced it will end Temporary Protected Status, TPS, for roughly 72,000 Hondurans and 4,000 Nicaraguans by September, people who've lived under this status since 1999. This follows the termination of TPS for hundreds of thousands from Venezuela, Haiti, Afghanistan, and Cameroon. These decisions aren't just paperwork. They're ripping tens of thousands of workers out of the economy, and not just in the informal sector. And this is the part most people miss. The loss is becoming quantifiable. J.P. Morgan economists Joseph Lupton, Michael Farrelly, and Abel Reinhart now estimate that recent policy changes will strip legal status from about 1.1 million workers. This could shrink the U.S. workforce by nearly 0.8%, nearly 1 out of every 125 workers, just as the U.S. economy is grappling with the challenges of an aging native-born workforce. As a result, economic growth is likely to take a meaningful hit in the second half of this year. What's more, rising detentions mean the informal economy, which often absorbs those without paperwork, will have a much harder time picking up the slack. Here's where things get even more uncomfortable for businesses, consumers, and policymakers. If current trends continue, we could see about 117,000 workers vanish from the economy each month this quarter, with the pace accelerating to 150,000 monthly losses by the final quarter. We thought immigration would slow to a crawl, not actually reverse, but now it looks like both are happening at once. The J.P. Morgan team wrote in a note that's quickly becoming required reading in boardrooms and trading floors. Apollo chief economist Torsten Slok put it bluntly: if unauthorized immigrations are deported at the current clip of 3,000 per day, the labor force will shrink by 1 million this year. That's enough to drag down labor force participation, slash job growth, and, here's the controversial bit, push up wages, especially in construction, agriculture, hospitality, and leisure. Why? Because suddenly there are fewer bodies to fill those jobs. Bottom line, deportations could spark a stagflationary impulse in the economy, lower employment, higher wage inflation. Slok wrote, And here's something to chew on. A recent report from the American Enterprise Institute suggests that under these policies, migration could actually swing negative, meaning more people leave than arrive. While GDP growth might drop 0.3 to 0.4 percentage points this year, with payroll growth potentially stalling or even turning negative for years to come. Barclays, too, warns that U.S. job growth might flatline over the next 18 months, thanks to both fewer migrants and a rapidly aging domestic workforce. Like tariffs, the full economic impact of these immigration changes hasn't yet landed. Many of the status revocations still have months to go. But unlike the fuzziness around tariffs, the labor market effects are much clearer. The workforce is about to get a lot smaller, and the repercussions will ripple through every sector, raising wages for some, causing labor shortages for others, and squeezing growth for all. So here's a question for the comments section. Is this the price of enforcing immigration laws? A trade-off between control and economic vitality, between order and growth? Could there be a smarter, more humane, and more economically viable middle ground? Or are these the growing pains of a nation looking to redefine itself? Let us know where you stand. For those hungry for more analysis and global insights, be sure to check out Reuters' Open Interest for sharp commentary on financial markets. And if you're a market watcher, don't miss the Morning Bid US newsletter for your daily briefing on what's moving the money. Column by Mike Dolan. Edited by Kirsten Donovan. 2. Economic warning. Over 500,000 could leave the U.S. this year. Is the U.S. on the brink of an economic crisis due to drastic immigration policies? This year, more than 500,000 individuals might depart from the United States, largely influenced by President Donald Trump's strict immigration strategies. Experts warn that his extensive deportation efforts and entry restrictions could significantly reduce the number of foreign-born laborers, ultimately harming the nation's economy. A recent study published by the American Enterprise Institute, AEI, which is known for its conservative stance, forecasts that the United States could experience a net migration decline ranging from a startling negative 525,000 to a more moderate decrease of 115,000 this year. This prediction points to a significant drop in immigration inflows alongside an uptick in outflows, marking a stark contrast to the nearly 1.3 million net migrants anticipated in 2024 and the mere 330,000 in 2020, when the onset of the COVID-19 pandemic curtailed global travel. Should the lower estimate materialize, it would mark the first instance of negative net migration in several decades, a situation that could reshape the country's demographic landscape. Foreign-born individuals represent a crucial portion of the American labor force, accounting for about 19.2%, according to the Department of Labor. Moreover, immigrants contribute significantly to consumer spending. Hence, a decline in migration has the potential to exert downward pressure on both the labor market and consumer expenditure, possibly causing a reduction of up to 0.4% in the GDP for this year. This finding aligns with insights from the Federal Reserve Bank of Dallas, which recently suggested that decreasing immigration could result in a GDP growth hit between 0.75% and 1%. The decrease in migrant inflows, along with the broader decline in the foreign-born population, will negatively affect the expansion of the U.S. labor force and will resonate across virtually every economic sector, remarked Madeline Zavodny, one of the authors of the Dallas Fed paper. This decline is further aggravated by the country's low birth rate, a troubling trend that contributes to an ever-decreasing share of the population within the working-age demographic. Zavodny emphasized the significance of new immigrants in sustaining growth in vital sectors such as agriculture, construction, and healthcare, stating, "The U.S. population is aging, and we rely on new immigrants to help fuel growth in the labor force and key sectors." In a response to these concerns, White House spokesperson Abigail Jackson defended President Trump's immigration agenda by stating, "The initiative to deport criminal illegal aliens will enhance the quality of life for all Americans. It means that American taxpayer resources will no longer be overstretched and exploited by undocumented individuals." She further asserted, "President Trump is ushering in a golden age for America, bolstering our economy with American workers." Giovanni Perry, a labor economist and professor at the University of California, Davis, elaborated that sustained drops in net migration would most heavily impact low-skilled positions, particularly in sectors like construction, agriculture, hospitality, and personal services, where American-born laborers are less likely to fill the void. This deficit could lead to price increases in these industries. Stan Vuger, a senior fellow in economic policy studies at AEI and co-author of the aforementioned working paper, agrees, pointing out that the agriculture, leisure, and construction industries will be disproportionately affected by the decrease in the labor supply. He also highlighted the anticipated repercussions on demand, noting that a reduction in foreign-born workers would heavily impact the real estate, retail, and utilities sectors. Perry indicated that while larger firms might draw in some more workers, often offering better wages, smaller firms are at greater risk of closure due to their lower productivity and tighter profit margins. Zavodny noted that small businesses would face substantial challenges, particularly because they traditionally struggle to navigate temporary worker programs such as the H-2A and H-2B visas. However, she added that large employers would not escape unscathed, and that everyone will lose some of their customer base. According to the American Immigration Council, the foreign-born population in the U.S. wields approximately $1.7 trillion in spending power, of which undocumented immigrants contribute $299 billion and rented about $167 billion worth of real estate in 2023. As clarified in AEI's report, reduced spending is likely to lead to diminished business revenues, which may trigger layoffs and create additional strain on the labor market beyond the declining workforce itself. Despite these dire predictions regarding the economy, Trump shows no indication of easing his immigration-related campaign promises. Deportations continue at a rapid pace, and the president recently endorsed a GOP reconciliation bill that allocates roughly $150 billion to assist in enforcing his immigration agenda. When asked whether the potential economic ramifications might inspire a reevaluation of the administration's stance on immigration, Stan Vuger replied, "I would love to think so, though my optimism is limited. I believe the architects of immigration policy in the White House are indifferent to the economic and humanitarian consequences of their strategies." But here's where it gets controversial. Can an immigration policy centered on deportation really ensure a more prosperous future for American workers? What do you think? Is the administration's current path likely to enhance or hinder economic growth? Share your thoughts in the comments below.